Imagine waking up tomorrow and seeing a notification from your bank. Not a payment request, not fraud, not a mistake. Just a quiet message. We have reduced the value of your money by 8% this year. No transaction history, no withdrawal, no explanation. You check again, your balance is the same, but somehow it buys less. No one voted for it, no one approved it, yet it happened. Because this already exists, and you pay it every year. Here's the strange part. Nobody took your money. Your bank didn't steal it. Hackers didn't touch it. The numbers didn't change, but the value did. Last year, maybe $100 bought a week of groceries. Now, maybe it buys 5 days. Same money, different power. And that's when you realize something uncomfortable. Losing money doesn't always mean losing numbers. Sometimes it means losing what those numbers can do. Most people think taxes only exist when governments send a bill. Income tax, sales tax, property tax. You see them, you feel them, you complain about them. But the biggest financial drain most people experience, it never arrives in your mailbox. It never asks permission, and nobody calls it a tax. It's called inflation, and it might be the most effective tax ever created because most people don't realize they're paying it. Imagine two versions of you. One version saves money, disciplined, careful, patient. They put away $10,000. They don't touch it. They do everything right. The second version spends everything. No savings, no planning, no patience. Now logic says the saver should win, but the system has a twist. If inflation runs at 8%, the saver quietly loses buying power. Not because they failed, but because they stood still. To understand this invisible tax, you need to understand something most people never learn. Money is not created the way you think. Most people imagine money gets printed first, then spent. Reality is stranger. Most money is created when debt is created. Loans create money. Government borrowing creates money. Bank lending creates money. The system expands through promises about the future, not piles of cash. Think about it like a pizza. If there are 8 slices and 8 people, everyone gets 1 slice. But if suddenly there are 16 people and still only 8 slices, nobody stole your piece, but it just got smaller. That's inflation. More money, same goods, smaller value per unit. Now let's make this uncomfortable. At 3% inflation, your purchasing power halves in about 24 years. At 5%, about 14 years. At 8%, about 9 years. That means money saved today could lose half its strength before your career even peaks. You didn't spend it, you didn't lose it, time did. And this is where the system becomes quietly brilliant. Visible taxes create resistance. Invisible ones create behavior change. People don't protest inflation, they adapt. They work more, invest more, borrow more, take risks they normally wouldn't take. The system doesn't just collect value, it shapes decisions. Here's the part rarely said out loud. Inflation helps debt-heavy systems survive. Governments owe massive amounts. If wages and prices rise, old debt becomes easier to carry. Same number, less weight. Inflation doesn't remove debt, it slowly shrinks its burden, quietly, over time. This is why something strange happened in modern finance. Savings stopped being enough. Cash alone slowly loses ground, so people are pushed toward investing, stocks, real estate, assets, not to get rich, just to avoid falling behind. And here's where inequality quietly grows. People who own assets often benefit. Asset prices rise over time. People holding only cash often struggle more. So the invisible tax doesn't hit equally. It rewards position, not effort. Inflation doesn't just change prices, it changes behavior. It rewards speed, punishes waiting, encourages spending, discourages holding. It turns money into melting ice, and nobody likes holding ice. The real danger isn't inflation itself, it's when trust breaks. Because modern money runs on belief. belief it holds value, belief systems remain stable, belief erosion stays controlled. And history shows trust breaks slowly, then suddenly. So here's the strange reality. You can work harder, earn more, save more, and still feel stuck. Not because you are failing, but because the system itself keeps moving. Which leaves one uncomfortable question. If saving money guarantees slow loss, what does financial safety actually mean anymore?